Joining us now to break down the numbers, Brandon Oglenski of Barclays, who has a buy rating on both companies. Brandon, thanks for joining us today.
Yeah, thanks, Morgan, and thanks for calling out the buy rating on stocks that are down today, but sure, we'll talk about that.
Well, I mean, the fact that they're down, is it a buying opportunity?
You know, we actually think so. Look, transports are very cyclical, and I know you were talking about a recession right before going into the break. You know, I would argue we've actually been in a freight recession now probably since the third quarter of 2022. That's when retailers really started to slow orders coming in from Asia. We saw import activity in this country. So think of the freight volumes coming through the ports decline like 15 to 20% in the last 3 quarters. And we think the bottom was actually sometime around April or May. We've actually seen sequential improvement in import activity. You know, we heard that echoed last night from J.B. Hunt. We actually heard it in night results today saying, look, you know, April was the slowest, and we see signs that retailers are actually stopping their destocking and need to get some more volume here in the country. So I get it. I know people are worried about high inflation, higher interest rates, but I do think from a freight perspective, we've already been at the bottom and most likely going to climb out here in the back half of the year.
What's more important right now in terms of trajectory for these stocks? Is it hitting the bottom and seeing stabilization, or is it more meaningful signs of actual recovery and upward pressure, I guess, then, or recovery of pricing?
Yeah, great question, Morgan. I mean, look at Knight. This is a mid-cap stock, right? They're the largest truckload carrier in the U.S., but it's so disaggregated. They're only 2% of the market, so I'll start there. But, you know, they pre-announced maybe a week or 2 weeks ago, and the stock's only underperformed by about 3% since then, because I think the market realizes we are close to a bottom, and we're seeing some stabilization in market pricing for truckload. You know, on the flip side, CSX, obviously much larger market cap here, going to have a much wider investor audience. You know, railroads in general and even CSX, they've all lagged the market this year, you know, even worse than trucking, because trucking's generally viewed as early cycle. Rails are generally mid-cycle. I think what people want to see for railroads is some stabilization in volumes. I mean, volumes this quarter were down 5%. We do think that they could actually turn positive maybe by the end of 3Q, if not into 4Q, because, again, we're going to be lapping the declines in imports by then. But look at CSX. I mean, we'd argue there's an opportunity there now. It's trading about 15 times, pretty big discount to the market.
But Brandon,
and they're outperforming, you know, with volumes down 3% versus a market down 5%.
I wonder about cost pressures, not only from labor unrest that we've seen, but also safety regulations, and then, you know, these volume issues potentially continuing as the economy slows.
Yeah, John, great question. So, you know, on labor inflation, CSX has actually been the first one out there to try to resolve these sick day issues with their labor unions. I really like what new CEO Joe Hendricks is doing with his One CSX initiative, really engaging his employee base to get everyone, you know, rowing in the same direction. I think that's showing some results because they do have industry-leading service right now. I know safety is at the forefront, especially given the tragic accident in Ohio, you know, back in February. But what we've seen is collectively the industry come together to deliver better results, really focusing on getting more headcount on the system and being prepared for the next upside. And we just think CSX is that much further along compared to some of their competitors.